one of the biggest issues is that problems for Canadians is that they tend to believe that they actually do last forever. Canadian consumers are very highly leveraged, the highest we've seen in history right now, meaning they carry a lot of debt relative to their income. And so if you're...
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
The question of the day is that do you believe that, historically speaking, the past heavily dictates the future as it relates to interest rates and market conditions? Depending on your beliefs and your thoughts on whether the past is indicative of what will happen again in the future, or at least to a degree, you'll agree or disagree with the information I'm about to share with you today. Now, this is a full breakdown of, historically speaking, how the last 30 years of real estate and interest rates could be a predictor of what's about to happen in the next couple of years, and how you can make a better interest rate decision based on knowing how rate cycles work. It's going to be a lot of information, I'll be honest with you, but I think it's worth a listen here. So in the next little bit, my hope for you is that not only do you have a clear understanding specifically of how these rate cycles work, but more certainly how you can use this information to affect your day-to-day life and use it to be more impactful, or at least stress out a little bit less. Now, just to give you a heads up, this information is inspired by a good friend of mine, as it often is, Mr. Robert McLister, who put out a great article, and I tore it apart and went even deeper on the information, as I like to do, so that you have a lot more to chew on in terms of making these decisions. Now, before I go any further, if you're enjoying the information in these episodes and you love the data that we're coming in with, do me a solid and hit subscribe, whether you're on iTunes, Spotify, YouTube, whatever, and give me a great rating. I'd love that. Share it with people, whatever. It helps me to continue to support you and spend the time every single week to break down this information. So let's get right into it and talk about exactly how these rate cycles are going to impact you as it relates to making your mortgage decision. Now, starting off here, I would suggest that you start to imagine driving without a GPS in a city that you've never visited. So no Google Maps, no Apple Maps, nothing. And you might eventually get to your destination, but the journey, I'd say, it will be pretty stressful and probably pretty unpredictable. Understanding interest rate patterns is like having a GPS as it relates to navigation. Although it's constantly changing and fluctuating, it will help you get you to your destination faster and with a lot more confidence as you're trying to go down that road. Now, notwithstanding snow in Vancouver or the Fraser Valley and unforeseen events like that, which happen in real estate as well, this is going to get you way closer to understanding exactly how you can make those decisions. It really matters for you if you're a homeowner, if you're an investor, if you're anybody who is impacted by anything to do with rate or payment fluctuations, which virtually everyone is, there's a direct impact on your long-term and short-term financial goals. So understanding at least the basics of this is key to being able to make a good and educated decision. And without understanding some kind of a bigger picture, I would say most people feel or could feel pretty blindsided by the events. Now, notwithstanding the events of 22, 23, where interest rates went up 4%, which we could argue we should have foreseen to a degree, and many did call for rates to increase, just maybe not to that level. This puts you in a position to be able to understand it more clearly. So what I'll cover here for you is a simplified breakdown of the rate cycles and what drives rates in Canada and the US, again, to be simplified, and how you can apply this information. So if you stay to the end, I'll actually explain to you how you can apply this information to your own specific mortgage situation. But first, one of the questions I do get asked, and I get asked in a variety of different ways, are what are these rate cycles? But usually people ask it like, well, what is going to happen in rates and what's happened in the past? And basically what they're saying is what are cycles of interest rates? Now, cycles can be described as the ups and downs of rates over time, influenced by central banks like BOC, for example, in Canada, or the Fed in the United States policies. Obviously, inflation has a big impact on this. So if you're clear and aware of how inflation impacts the economy, then this will be a little bit easier to understand. But in simple terms, inflation is the cost of money going, or the cost of goods going up or down. And essentially, when inflation continues to increase, the monetary policy's primary goal is to decrease inflation. And there's a variety of different manners that they use to do that. But the biggest one that they can use to increase or decrease the effects of inflation is to increase interest rates to reduce it, or decrease interest rates to have the adverse effect. Now, we're in a state right now in our rate cycle, depending on how you look at it, where, of course, the BOC in Canada is reducing interest rates. Therefore, they believe that inflation is coming down and they don't need to continue raising it for the time being. But if you look at back historically, like the best way to think about this is like waves in history as they rise and fall in response to a variety of economic changes. Now, if we look at since 1991, Canada's overnight rate has had 8 major peaks, roughly every 5 years. So if you're wondering how often does this happen, every 5 years or 63 months, after each peak, rates decline as the economy tends to slow down. Now, these rhythms give us clues to having a better understanding of when rates will go up or when they're going to fall next time, but it's not perfect math or perfect science. The US economy and Canada, the Canadian economy themselves are tied very closely together, as you probably already know. But I still find that most people don't understand, why does the US drive Canadian interest rates? Well, Canada exports a massive amount of its exports, think like oil and lumber and cars, down south to the United States. So what happens down there has a direct correlation, obviously, on what happens up here. When the US Fed changes interest rates, it affects trade, it affects the costs, it affects the overall economic activity, because again, because of the fact that we trade so much with our southern partners, when something goes up in cost there, it has a direct and immediate impact here in Canada. Historical patterns show that the Canadian and US rates often peak around the same time, unsurprisingly. And that number is so tightly correlated. It's over a 90% correlation between our interest rates, that all you have to do is really look at what's happening in the US to dictate what's happening in Canada. Now, things can spread apart like they've done most recently, where the BOC has been forced essentially to reduce interest rates much faster than the US, but there's obviously negative repercussions in Canada. Case in point, our loonie is dying right now. So a big part of that. Just to give you an example of where this comes in 2000, so in the year 2000, Canadian rates briefly diverged as the Bank of Canada defended the weakening Canadian dollar. So they spread apart. Despite that, interest rates eventually realigned with the US policy. So our policies, our monetary policy, the BOC and whatnot, they try to obviously keep our dollar strong. That's one of the mandates and one of the goals above all else. But of course, it can spread. However, over time, it continues to find its way right back. So the question I'm getting asked is like, okay, well, history is history, whatever. But how does today correlate with what happened in the past? So we try to look at some of the parallels of the year 2000. So for example, just reading off some notes here, AI and tech innovations right now in 2025 are very unique to what we had with the quote unquote .com boom and internet, and how big. Let's fix that. Gotta stop slamming things down, apparently. All right, we'll pick back up where we were in a second. So yeah, basically, essentially, the 2000s and 2025 have a very, very clear correlation as it relates to tech. So AI, the .com, those booms were massive in 2000. Now, I'm not going to say that AI is a boom per se, but it is going to revolutionize life and business as we know it. And there are a lot of similar correlations from that time. Plus, in addition to that, we had inflation pressures, we had housing price surges, we had a growing economy, a lot of similar factors which could mimic the 2000 timeline in 2024, 2025, which could lead to surprise and change rate movements even if the markets are expected to fall, which basically means even though many markets are predicting that we see a significant rate reduction in 2025, there is a possibility that because of these common patterns, if we look back at a graph of the 2000 mark, things could diverge and we could see a surprise jump back up before falling down again. So let's talk about some of the factors that are impacting today's rates and what impacts rate decisions. Like, okay, so before I get into it, so what impacts rate decisions? So first and foremost, inflation is number one. We mentioned that right away. So the central bank's mandate obviously is to cool inflation, number one. So the primary focus is, okay, well, if inflation is going really high, we're going to raise interest rates. Example, prices rise too quickly, borrowing becomes more expensive to slow spending. So we know that's not mandate number one. Number two is economic growth. A strong GDP growth, which we're not seeing right now, obviously, can lead to higher rates because it signals the economy is healthy enough to handle higher borrowing costs. Now, notwithstanding the fact that the jobs report in Canada came up pretty strong here recently, GDP overall is in the toilets, as most economists would agree, and it's not looking very strong, at least not today. And so, for many reasons, of course, there's another mandate that they could continue. There's sort of pressure downwards on interest rates, basically. The third factor that drives interest rate decisions is going to be global trends. Global markets, specifically the United States, as we talked about, impact Canadian rates because of the trade investment flows. But it's not only the United States. Of course, there are global markets that we look at outside of that, which can impact our dollar, our inflation, anyone that we continue to trade with. So, what is the role of policy changes and lags when the central bank itself changes rates? We need to remember that these rate changes, so even though we saw 1.75% in the last 6 months, those rate changes don't show up immediately for a variety of reasons. It takes its time to work its way through the economy. There are people who are locked in at mortgage rates and terms where they may not actually see any changes to their budget despite having taken a variable rate because maybe they had a fixed payment, or maybe they're in a fixed interest rate and it doesn't even affect most of those people, not directly at least. I mean, indirectly as it relates to the cost of goods, but for the sake of conversation, there's not like a direct correlation. So it usually takes, on average, about 1 year to 2 years to see the full impact of any rate changes, which means that with rates coming down recently and in July of last year, the first rate drop, the chances are we probably don't really see the major impacts of those rate changes other than the psychology of those changes until sometime this summer, which is the true measure of when we'll start to feel any positive or negative impact of doing so. For example, if the BOC rates changes rates again in January, that impact probably won't be felt until the end of the year or next year for that matter. Another thought here, because I constantly hear the feedback, well, rates are going to spike. What happens if rate spikes? Or rates spiked in 2022 or rates spiked in 2023? They just don't last forever. And there's this common fear of consumers of taking a variable rate mortgage because they think rates are going to spike and those spikes are forever. I mean, look back historically at the last 5 years, 10 years, 15 years. There have been many cycles in that time. They do not last forever. But one of the biggest issues is that problems for Canadians is that they tend to believe that they actually do last forever. Canadian consumers are very highly leveraged, the highest we've seen in history right now, meaning they carry a lot of debt relative to their income. And so if you're carrying a lot of debt relative to your income, you're more highly sensitive to rate changes, whether it be from your line of credit or your mortgage. And so for these rate spikes, they do have that instant 1 to 2 year effect, which is why these rate cycles don't last very long. If rates rise too high for too long, Canadians would be struggling to afford their payments, forcing the BOC to cut rates, obviously amid any economic downturn, of course. And history shows that these rate hikes themselves rarely last beyond 18 to 30 months before any easing begins, which explains the current rate cycle that we're in right now. So now that you have a general idea of what happens in these rate cycles, I think it would be important to understand some of the data and then factor in what some of the strategies are that you should consider. So I've got a few charts out here, again, thanks to my friend, Mr. McLister, that have shown us the 3-month versus 18-month moving averages of overnight rates. Now, basically that gets rid of all the jagged lines and it provides like a little bit more of a smooth graph to have a better understanding of a period of time. So 18 months is an average over that period of time, 3 months an average of that period of time. And they obviously move pretty closely. So the 18th month average basically helps to identify more specific trends by removing those little jump ups and jump down. And we have to remember that when we're looking at these graphs and looking at these charts, The rates that are today are based on decisions from 1 to 2 years ago. So if you're somebody who's a borrower, buyer, or Canadian, you need to focus more on forward-looking indicators like yields and inflation trends. And most Canadians are not looking at that, which is why often they're not making good decisions based on historical evidence. They're making decisions based on today and how they feel versus the markets and what could happen and a strategy associated with that. So for example, if you're in a variable rate mortgage right now, you want to be watching for indicators like falling 2-year yields, which is the possibility of a sign of rate cuts. You also want to look at inflation reports and have a general understanding of what's happening in the markets as far as a slowdown. Now, we live in a time where this information is categorized and people are talking about it on such a regular basis that you can't get away from it. But the key is to actually dig into the data as it relates to making those decisions and being informed about it. So, what is somebody to do? All right, so let's get to the point here. So, what is somebody to do in 2025 as it relates to picking a mortgage product? I think there's a lot of different takeaways that you can have here, and it really depends on your financial goals. And remember this, like there's a difference between somebody who's being a first-time buyer, just getting into the marketplace, who is upsizing and they're just trying to obviously hope on focusing on having good cash flow so they can enjoy life with their kids, versus someone who's kind of in their latter years where they're thinking of saving and investing, and even somebody else who's in a place where maybe they're on the down end and they're trying to retire and look at different options. So let's just walk through a few potential options that might be impactful for you. Number one, there is something I've talked about it previously where you can consider rate diversification. Now, this can work in a few different ways, and I've done it myself in the past, so I can speak from experience, but there's so many ways that a hybrid type of mortgage could be beneficial. And it's not just like 50% fixed, 50% variable. You could put different term lengths, although the challenge associated with that is that when you get to the end of your term, you might end up having two different term lengths, which means you could end up paying a penalty. But you could be looking at things like, today, if you believe that the fixed rate market is the safe and steady and rates are going to go up, and you still kind of think that that variable market has an opportunity to win, well, you could say, for example, combine 60% in a fixed rate and 40% in a variable rate as an option. So the fixed rate is going to give you that stability that you're looking for, and the variable rate is going to give you cost savings if you believe that the BOCE is going to start heavily cutting rates as per some of the reports that you've seen in the marketplace right there. That's one way to go about it. I've actually seen and talked to other clients where we've gone even deeper, where we've done like 3 components, where we did a fixed rate component, a variable rate component, and a HELOC component. And a big part of that came down to their financial strategy for the next 6 months, 12 months, buying a second property, third property, selling off a property, paying down the mortgage without having to pay out any debt. Either way, there's a lot of different ways that you can cut the cake, and you can benefit from the possibility of a hybrid mortgage. But what you need to know about a hybrid mortgage is it really needs to be managed and maintained. It shouldn't be considered, hey, I'm just going to go to the bank and pick this out. I mean, if you feel comfortable doing so, but when you're picking that product, you need to be talking to and understanding that lender's prepayment policies, how many different components will they provide, what is the frequency at which they make the changes, and then, of course, understand the mortgage parameters. For example, is this a fixed payment variable, which brings me to my next point around payment protection. Is this a fixed payment variable? And this is with a variable rate mortgage where if rates go down, you do not see the benefit of your actual payments declining. You see the benefit of having more money going to principal and less money going to interest. That can be good and bad. I mean, the reality is you're paying down faster, but if you want cash flow in your pocket and you want to invest that money or see the benefit of just paying less monthly out of your pocket, then of course you're not going to want to have that option. The other option as it relates to payment options is to go with something like an adjustable rate, ARM. They're not as prevalent, but they are available. And this is where payments rise and fall based on the marketplace. A lot of people actually liked this product when rates went up and went down because they knew they were paying off their mortgage in the same amount of time. But we also had a lot of people who say they didn't like it because of the fact that quite simply their mortgage was in a position where they had to continue paying these high payments because they went up so high and so fast, and it was devastating to their budget. So you really have to know your personal financial situation to figure out which one of those options makes sense. Now, this is more of a subjective thing, and this is something that is in doing a little bit of, I don't want to say research, but looking at some of the options that are out there. Some people presented as an option is to always have enough to cover at least a 30% increase payments for 30 months. Now, I do not disagree with this. I think that the reality is that not enough people are prepared to make up a difference in their monthly payments, which is why they get to a point in which they can't make them and life changes. And so the thought process is you want to test your mortgage for an increase of 30% over 36 months. And so, for example, if your mortgage payment is $2,000, you would want to times that at 30%, which is $600, and be prepared for your monthly payment to rise up to $2,600 for the next 3 years. And ask yourself the question, could I make that payment in a worst case scenario if the market did another complete flop 180 and we saw rates continue to go up? And the reality is, I just don't think most Canadians are in a position to be able to do that, not only because they don't think about it, but because they just financially are potentially over leveraged. Now, this doesn't mean that you can't qualify to the higher end of your scale, because you also have to factor in your own personal income, whether it's going to go up. Do you have a nest egg available instead of, hey, for example, having funds, just a cash in pocket? Maybe you have $100,000 emergency fund for something like that. It can be done in so many different ways, but can you make the payments is really the key question in terms of making those decisions. So that was a lot of information, and this is pretty heavy to start the year. But the point of all this is that these rate cycles, if you're paying attention to them, kind of give us a little bit of a roadmap to understanding the specifics of what could happen and what's happening right now in this current marketplace. And the thing is, no matter what we think, surprises can still happen. And that's why they say economists are right when they're right and they're wrong when they're wrong. They're only right about 50% of the time at best. And they're basically just paid to guess. And that's just the nature of the game. You should think about the possibility of diversification, specifically if you're someone that's coming up for renewal in 2025. I see far too many people just taking whatever's the cheapest rate option with no thought process on their personal financial situation and what's happening in the marketplace. They're just, hey, what's the cheapest rate? I'm going to sign in. And for sure, for some people that will benefit them. But I also think there's a large percentage of people where they're actually not going to be in a better financial situation because they don't know what they're doing with that money. If you're not the type of person to spend the time looking at policy yields and bond yields and run amortization simulators, then at that point, you should be reaching out to myself or my team, specifically my team at Flow Mortgage Co., because all of the information that we provide is data-driven and based on information which we get up to date on a daily, if not weekly basis. Here's the thing. Rates may rise and they might fall, but with the right prep and the right advice, you can turn any financial uncertainty into an opportunity. And it really just comes down to having the right type of strategy in place and being aware of the information that's available to you. Again, if you found this information helpful, drop me a like, a thumbs up, a rating, share it out. And if you're someone who is looking to invest, buy, or has questions about a renewal, reach out to the team and the links are below. We'll see you on the next episode.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.